Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Jeff McKee. He is the active general partner, syndicator, and passive investor in ATM Income Passive Income Fund. He has over 3,400 apartment units and is an asset manager, and the assets are managed that he's managing are valued at $250 million. He is the founder and managing partner of McKee Capital Group. So, welcome to the show, Jeff.
Yeah, thank you, Keith. Great to be here.
Yeah. If we could maybe start with kind of where you grew up and what eventually led you to real estate, that'd be great.
Yeah, sounds good. So born in California, Travis Air Force Base near San Francisco. My dad was in the Air Force early on, lived in Japan on a U.S. Air Force base there for a few years when I was a kid. Came back. My dad got out of the service. He got in the hotel business. So he eventually became a general manager of Host Hotels, Marriott, Doubletree. And so we moved around a bit. So we went from Sacramento, California after 10 years when I was growing up to Dearborn, Michigan for a few years there, and then to Houston, Texas. And then that's where I went to high school, met my wife. We've had three kids. I started my first major job at Compaq back in the late 80s when Compaq was booming. In Houston, the Compaq Computer Corporation. So did some of that early on. And then I spent 16 years at Microsoft, took early retirement, a few years ago after reaching financial freedom from investing in a lot of alternative assets over the last, 5-7 years.
All right. Fantastic. There's a lot there for sure, but we'll dive maybe into some of that. So as far as real estate itself, when did you start investing and in what format did you initially start?
Sure. So when I turned 50, it was some years ago, we were just looking at our portfolio and it was all stocks, bonds, 401ks, some rollover IRAs, things like that. Some people were managing money for us and it just wasn't, going as fast as I would like. Then I realized, I need to be more educated. And so I started listening to, hundreds of podcasts, reading a lot of books. And then we started joining masterminds. So the first mastermind we joined was around single family, just like a lot of people do. Hey, I want to get in the real estate game. Let's go with single family. If I could own 10, 20, 30 doors, that would be great. And so we joined a mastermind here in Austin, Texas, doing single family. We did one fix and flip. We did one buy and hold of a duplex. And then we did a tear down we bought from a wholesaler, and then we built 2 houses on it. One we turned into an Airbnb, and the others our primary residence. So we did the single family, and we got a taste for what it was like to basically control your own destiny. We set up a family LLC with one of our sons who invested with us, and so he learned along the way. So he was 25 at the time. So we got, some of the family involved in this. And then that was the first thing. Then the next thing, I was introduced to a group, multifamily. So apartment investing, which I didn't know just regular people could invest in apartments. So then after about a year of single family, we went to some multifamily. We got educated, went to some seminars, boot camps, et cetera. So we joined a multifamily mastermind at the limited partner level because we weren't ready to become general partners. So basically, passive investors. So I had, a rollover IRA. So we got introduced to a bunch of people that were, shopping around deals, and we were in the market. So this was 2018. So we invested in 5 deals with 5 different syndicators in that master group, if you will. And 2 of them were in Dallas, 3 in San Antonio. So we did that. Then over the years, we started, hearing about, well, if you want to accelerate even faster from being a limited partner, you may want to consider becoming a general partner. So then we joined another mastermind group and we became general partners in that multifamily group. So over all of that, over a period of 3 or 4 years, we accumulated, 3,400 units that we're partial owners of, $250 million. So that was the single family to multifamily. Then obviously, as we know, multifamily's been going through some tough times. And so, like many syndicators, I started looking at different asset classes. So then I partnered with another group of people on a large land deal north of Austin, 2,000 acres. So we syndicated that. We invested in it as limited partners. Then with that same group of people, we also took over a producing oil field south of Austin. And so we syndicated that, invested in that, personally. Then I got introduced to automatic teller machines, ATMs, an ATM fund, because I was by this point having left the high-paying W-2 job, and I was looking for that regular monthly income. And so these last 3 deals, syndications, were for accredited only. So this ATM thing I'm talking about is for accredited only investors. The apartment syndications, we did all non-accredited and accredited, what they call a 506B, and these other deals are 506C, accredited only. So we invested personally in this ATM, and it was going really well. I was telling, friends and family about it. And so then I ultimately became a fund manager. And so I have a fund, a feeder fund that feeds into the master fund. And so I basically, offer this to my investors that are looking for stable, monthly cash flow of a one-time investment that you make. It's purely a passive investment. And then it pays out over 84 months, over 7 years. And so that's how I got eventually introduced into ATMs as an asset class that people could invest in and have some, regular monthly income.
Yeah, it's an interesting asset class. Obviously, ATMs are everywhere. Maybe to give us a little bit better understanding of what type of ATMs this group goes after, and talk maybe a little bit about some of the advantages with respect to depreciation. Anything that you can dive into that's unique maybe about that particular asset.
Sure. So what's unique about this is these ATMs, based upon how the finance industry in the United States is regulated, they useful life is 7 years. So these are all brand new ATMs we put in production. They cannot be refurbished, resold, sent to third world countries at the end of 7 years. They're scrapped. And then the investor gets a portion of the scrap value at the very end. So it's a 7-year depreciating asset with no depreciation recapture, unlike some of our other investments, right? There's no depreciation recapture at the end. And so this is equipment. And so the equipment, depending on what the bonus depreciation rules are, as we know, we're in flux right now. So here we are in March of 2024. The House has approved a bill. The Senate's looking at approving it to make the bonus depreciation retroactive to 2023. Then it would be 100% for 2024, 100% for 2025. As it stands now, 2023 was an 80% bonus depreciation year. So if someone put money in an ATM, let's just say it's 104,000 is the number. We go in 52,000 increments. So 104,000, someone would get a K1 of just over negative 80,000 for 2023. Then that remaining, let's call it $24,000, would get spread over the remaining 6 years just evenly. And then so you basically get 100% bonus depreciation of your investment. It depends on how much we're able to count towards year one bonus depreciation. So that's the depreciation piece. On the actual asset, there's about 16 million transactions a month on ATM. So it's still heavily used. We have twice as much money supply cash in the U.S. banking system as we did 10 years ago. These are retail ATMs. They go into convenience stores. They go into dispensaries. They go into washaterias. They go into mom and pop restaurants and bars that don't accept credit cards. There's a lot of them in the U.S. And then the people that use these are not necessarily a lot of people listening to this on a podcast. A lot of us wouldn't necessarily go out of network and generate a fee, a surcharge fee. Like, we try and avoid that. But about 20% of the U.S. population, I'm not saying citizens, but the population are unbanked or underbanked, meaning they may not have a social security number. They use prepaid debit cards. These debit cards they put in ATMs, they generate fees. The other angle that these ATMs provide a service are small businesses. Some small businesses like dispensaries, convenience stores, they can actually take all that cash every hour and put it in the ATM, and the ATM is super secure. So as they're making deposits, they're actually generating some fee income, some surcharges on that. Then the next customer comes in and they need cash, they take it out. So it's also becoming like a teller. It's a small bank without these small businesses having to hire, the Wells Fargo Brinks, to carry the cash around. And so we're seeing more and more of that, small businesses using ATMs as their banking system. But a reasonable portion of the U.S. population are just underbanked, non-banked, because they don't have a social security number and they prefer to be in cash. Some people just don't like credit cards.
Okay. And as far as the ATMs themselves, what is a typical ATM? What is the cost of something like that?
They're roughly $25,000 for an ATM, depending on how it's customized and when it's purchased, who it's purchased through. And so the way it works is, every month we have an investment cutoff for the fund, and people wire in their money. We determine how much money. Then we turn it over to a company called Paramount. They're the actual operator. Paramount places a purchase order with the ATM manufacturer to go produce that many ATMs for that month. It takes them a little while to do it. And then in the meanwhile, Paramount is negotiating contracts on where these ATMs are going to be placed. Now, the master fund has been around since 2012, and it's never missed a distribution to investors, even during COVID. So it's paid basically the same 24.9% cash on cash return paid monthly. It's paid monthly since 2012, since the inception, because you're basically buying in. Once we get those new ATMs in service, they become part of the pool of ATMs. So some ATMs are seasonal. You have some at ski resorts, some at beach locations. And so we basically smooth out for the investor how those surcharge revenues come in. And so you're basically participating in a pool of existing ATMs. Some of the locations, we've got some of these ATMs rolling off at the end of their 7 years. We have to take them out of service. Well, now with the new ATMs coming into service, we put those in that. In other cases, we've got new convenience stores, strip centers, restaurants, bars that are just opening up. They need an ATM. So Paramount negotiates with the owners to put the ATM in there.
Okay. And I'm sure it depends, obviously, on, how busy the location is, that kind of thing. But I don't know if you have stats on, what these things typically spin off as far as those fees and how lucrative are they?
Yeah, so it's anywhere from $30 to $300 a day. There are some like usury laws in the U.S. about how much you can charge. Like casinos, you'll see them charge $10. A lot of what the retail ATMs and non-casino locations are between $1 and $4, per transaction. But then there's other things like when someone checks a balance, there's actually a fee that the bank pays us as the operator of that ATM, like 25 cents. So if someone gets out $100 and they say, oh, and by the way, what's my balance? There's another 25 cents that the consumer doesn't get hit with, but the ATM's able to basically charge that to the financial institution. That's just another form of revenue that we get that surcharge revenue.
Okay. Yeah, that's interesting. And so you get the depreciation right up front. Tell me one more time, what'd you say the preferred return was that it's been spending on?
24.9% cash on cash.
Wow.
So for example, if someone invests 104,000, which is the number that we use, and there's a table that I've got, a document that I'll share later, how people can download an overview of this investment. But you basically get like 26,000 a year in net cash flow. So that's a $181,600 over 7 years. And so the payback period without depreciation benefits is roughly 4 years. But then with depreciation benefits, it's about 2.5 years. So if someone is able to offset some existing capital gains in that year by investing in ATMs, they get basically an earlier payback, if you will. Some people at this time, they don't necessarily have anything to offset that same year they invest in an ATM. So then those passive losses will just be a unlimited carry forward until they can use them.
Unlike apartment syndications, unlike some of the others with an exit strategy of either refinancing or selling, with this it's just kind of on a schedule, and you're basically getting paid back.
Right, and that's why this, for accredited investors, Keith, it's because people need to have a bit of money and they need to be looking for something. So the strategy for this part of someone's portfolio is the income strategy. It's not the growth strategy. The growth strategy could be double your money in 6 years in multifamily. It could be 3x, 4x your money on a land deal that provides no cash flow, but it could potentially have a big payoff after several years. So those are the different parts of the portfolio. This one is squarely in the steady income. And there is not doubling your money at the end of the 7 years. You're going to get a residual value, roughly $2,500 for every 104,000 invested. That's the scrap value of those ATMs. And so it's basically this high cash flow, but the actual, it's a depreciating asset is what you're investing in.
Yeah, that's different for sure. Yeah, and as far as the strategy, so part of what they're continuing to do, this company that you're working with, they are replacing existing ones that become basically they come to the end of their lifespan, and so you're just replugging them in at those locations, and then in the same time going out and finding new locations for each of them.
Exactly. And in some cases, there's a lot of different competition in the ATMs. So sometimes we'll negotiate to take over someone's leases. And so maybe we take over 300 or 400 from another competitor, and we take their machines out and we put our machines in. So there's different things that happen behind the scenes on how do you get your preferred location. And then if there's one location, say it's a new strip center in an unproven area, and that ATM is just not performing, then it's Paramount's responsibility to basically take that out of service and put that ATM in a more productive spot. So other things happen behind the scenes to keep up that preferred return.
Okay. And like you said, it's been open. This fund has been open since, you said 2020. Is that
2012?
Correct? 2012. Okay, yeah, a little bit more of a track record.
2012. Yes.
Okay. Now that's fantastic. Wow. What else would be good for the audience to know when it comes to the ATMs and some of the advantages of it?
Yeah, I mean, I think part of it is the transaction volume still remains high in the U.S. The government does provide monthly debit cards instead of food stamps in the old days. They provide debit cards, and some people use debit cards. They take them to the ATM, and then there's a transaction fee associated with that. So even though we may not see or use ATMs ourselves, there is a significant population of the U.S. that continues to use them every day. And then there are businesses that just prefer to deal in all cash. I mean, I'm sure over the years, a lot of us have seen, hey, if you're paying with credit card at this restaurant, it's an extra 3%, but if you pay cash, it's not, right? And so
Right.
some people just whip out their cash. Well, then they may need to go replace that if they keep going to these establishments that are passing on that transaction fee of 2.5%, 3%. And of course, American Express can be a little bit higher. And so some people just say, yeah, I just want to, and some people just prefer cash and having that and they don't always trust the credit cards or getting into debt. And then frankly, there's 20% of the population that may not have a social security number, may not qualify for a credit card. And so it's a cash-based society for some of those folks.
Okay. All right. Very interesting. Well, I definitely wanted to just kind of dig in there and find out. And so, where all are these ATMs placed? Is this like a North America thing, or is this
It's
here
the
in the
US. Yeah,
U.S.?
the United
Okay.
States, because of the US banking regulations, these ATMs don't go to Canada, Mexico, or Europe or any place. So these are just squarely in the United States of America.
Okay. Okay. Oh, wow. Very interesting. And do you have some of them that are in some of the casinos and that kind of thing with those higher rates, or is that
We do.
primarily?
Most of it is the dispensaries where you see a lot of the action because the United States still requires cash at dispensaries. If you go to Canada, they will accept credit cards, but the US is still cash. And then the dispensaries have to find a way to secure that cash because there's so much flowing and then there's so much outflow that they just deposit it back in the ATM. And so that's probably where we see some of the best performing ATMs. And then, some of the smaller casinos is where some of ours are placed, and convenience stores do quite a bit of business, with ATMs.
Okay, okay. And with dispensaries, obviously you're talking like marijuana dispensaries, that kind of thing.
CBD shops, right? Yeah, yeah. Where
Yeah,
it's
CBD
legal in
shop.
some states and other states, it's Delta 8, Delta 9, non-THC type businesses. But yeah, so a lot of states have some form of a cannabis or CBD type of establishment. I mean, they're just popping up all over the place.
Yeah, they are, and it seems that more states are kind of following suit, and so I mean, I could see that at least for the ATM investment just being an additional. I mean, this is something there's going to be a nice lifeline there.
Right,
So
right. Because you basically like have CBDs, then Delta 8, Delta 9, you have THC. Then as some of the states move to medical marijuana only, and then other states eventually move on to recreational use, within limited quantities. So yeah, it's a huge business, and then a lot of the states get to tax that because it's basically a taxable item that they keep instead of an under the counter gray market, black market type of a thing. Now it's an actual marketplace that they can tax that. So the states are pretty happy.
yeah, yeah, that's very interesting. I wouldn't have expected that to be part of the one of the driving forces or one of the biggest spots to be able to use it, but it makes total sense. At
Yeah,
least until maybe they change some rules as far as being able to pay with credit card or whatever. But very interesting.
yeah, exactly.
Um, and then Jeff, maybe let's maybe go back to some of the other investments that in syndications that you've done, if that's okay. Unless there's anything else that you'd like to leave folks on with respect to the ATMs. Okay.
No, no, no. I
Yeah.
think
So
that it's good.
yep. So you mentioned some land north of Austin and kind of syndicating that. Tell me a little bit about what the game plan was for that, and how the returns were made.
Yeah.
Um,
And so basically, it's a group that I've known for a while. They've done like 9 other raw land deals. And so this was like the 10th one in Texas. And so it's 2,000 acres in Gerald, Texas, north of Georgetown. And it's a ranch. And then it basically, the play is you do the entitlements. So you do fresh water, wastewater, you do the municipal utility district. And the MUD district, you have to get approved by the Texas legislature. So this MUD district application for this 2,000 acre that we're a part of got approved by the legislative session, the last session in Texas. So that one was a big check mark. And then working with Williamson County, they want to run a road through the property, which we're totally fine with. So there's all that entitlement things that have to be worked through, eminent domain, right of way, all that good stuff. So basically building some of the infrastructure. Then the play is once all those basic entitlements happen, we are not the developers. We start parceling out these 2,000 acres to developers in 100, 250, 500 acre parcels until it's all gone, and then we don't own any more of the land afterwards. But that's the play. It's basically a model where in this time frame, if all this falls into place, it's a 2x return. If this falls into place, it's a 3x return, and if this falls into place, it's a 4x return in roughly 4 to 6 years in that time frame. So that is and that one's still ongoing. So we still have another couple years. But yeah, we've already been offered double our money, but we're not, going for double the money. We're going for more than that. So we didn't sell.
That's great. Yeah, that's very interesting. What about from the investor standpoint on that one? I would assume if we're going through and getting the entitlements and all these things, you're not doing any kind of a distribution during that time frame. It's basically an investment that they're holding. And I guess you mentioned it 4-year time frame, but how long does it typically take to get those entitlements through?
Oh, yeah, it can take 2 to 3 years probably to do it the full entitlements, depending on the planning zoning commission and other obstacles that protests that you might run into. But yeah, ours is it's pretty much on track. So this particular property, yeah, it'll probably be 30 months, and we should be all done, and then we can start putting blocks up for sale to developers.
Okay. And so are you putting roads and everything in and bringing in city infrastructure, or is that not part of?
No. So we're just getting it entitled and zoned to be able to, like, say, mixed use commercial, right? That's the part where we stop. Yeah. The county will run a county road through there at their cost, right? But then we won't be doing the subdivision and doing all, because we don't know exactly the highest and best use for that, let's say 100 acres the developer wants. Maybe they want to do 5-acre lots. Maybe they want to do 1/4-acre lots. So we're basically trying to just get all the zoning done and get the fresh water and wastewater, the mud district, all that stuff all set up. And then it's up to the developers on, do they want to do residential, commercial, mixed use, all that.
Okay. Yeah, that's pretty interesting in itself. And it's just one of those other things when it comes to investing. It's amazing what, it's a ton of red tape you have to get through. And obviously there's a nice price to be paid for, the land once it's through that process.
Right. And what they call it is shovel ready, right? That's what developers are looking for. They don't want to spend 2, 3, 4 years doing all those entitlements. They're willing to pay a premium to say, I want 100-acre shovel ready that has the right zoning for what I'm going to build for. And then they make an offer. So then that's the part that developers are looking for, because they don't want to, have a lot of holding costs.
Yeah, sure. Okay. And I'm sorry, what were some of the other ones, other investments that you had done? Obviously, the apartment.
Did an oil and gas deal, basically taking over an oil field south of Austin and north of Luling, Texas. So that stretch, it's been around since 1929. So it's almost 100-year-old field that's still producing oil. And, with geology nowadays, they know exactly how many barrels are under each well. And so basically taking over 52 producing wells. So now partnering with some oil experts, there's a couple gentlemen that are running the project that used to run it for another company, the same oil field they used to run like 3 years ago. So now they're part owners in this project. And so it's a very low risk because it's already producing oil. And then right now, the price per barrel of West Texas crude is, $80, $81. And in the business plan, if we ever get it to be above $90 for a period of time, that extra capital that gets generated, we have the rights to drill 12 more wells in this project. We may not get there, and that wasn't part of the base business case. That was just a little bit more gravy on top. If we happen to, if the price of oil happens to go above our strike price for a period of time, generating more revenue. But that one's been producing monthly cash flows to investors. It was after 3 months that we took it over that we did the first distribution. And so that's just another one. Now that one could be slightly more volatile than the ATM, but it's still another, resource that, the wind and electric and hydro haven't taken over, a huge percent of the energy in the U.S. It's still a lot of fossil fuels. So these are still very important, to the Texas economy and to others that want to pump gas in their vehicle if they still have a gas vehicle or a diesel vehicle. So yeah, these are doing very well. Now, the interesting thing about it is over the years, the federal government has moved away from a whole lot of subsidy and encouragement for investors to invest in oil and gas deals, and they've shifted those subsidies to wind, to hydro, to solar, right? So what's been happening is there's been a vacuum where there wasn't as much funding going into some of these oil field projects. So then they look for private investors. So that's where the syndication model comes in. Instead of just straight limited partnerships with a few people that were really wealthy like the old days, now you're starting to get more of the smaller investors at like $100K a pop coming in and investing in these deals. And that was another accredited only 506C deal. Same with the land, same with the ATM. And so these are just other alternative assets that can provide reliable monthly income for those people looking for that type of passive income.
Okay. Yeah, that's another one that's very interesting. We've had a few folks, obviously, after things slowed down just a little bit with multifamily, that kind of pivoted to that we've had on the show. But it's an interesting thing. So if I'm hearing you right, though, on that, Jeff, like you guys didn't just, this wasn't a ranch that you went out and purchased that was producing oil. It was you're actually partnering with these folks in order to help out with some of the infrastructure that they need. Is that?
Well, so basically, the company that owned the 52 leases, they wanted to take the gains from what they've been able to derive from this oil field, and they want to put their money into a much bigger oil field in far west Texas. So they basically want to go wildcatting, and they needed some capital. And so one way for them to raise capital is to sell these leases, the oil field, to another investment group, which was us. And it just so happened the lead people on it used to work with this company on the same field. So they know all the contractors, they know everything about all the wells. And so now they broke off from that company a while ago. So now they're basically owner operators of these wells where they used to be the workers in the field.
Okay. Yeah, that's interesting. And yeah, you mentioned the word leases. I mean, on a lot of these, they don't actually own the land, right? They're just own the mineral rights and the ability to be able to operate on the land.
Exactly. And then you pay the royalties, typically like 25% to all the royalty holders of any oil that you pull out of the well. So then there's a whole royalty process. And then, and then you buy the leases from the leaseholders. So yeah, it's, we don't own the land. We just own the mineral rights.
On that, so obviously, as you mentioned, the prices can fluctuate just because the price of oil fluctuates. But when you go into these and you take a look at them, at the head of kind of describing it, you had said, with geology now, you have the ability to kind of look and see how much more oil can be produced from these through a traditional method, like just pumping it out. And is there something that can be done by you all, the investors, that will allow for maybe it to be pumped out quicker or to get the return on it better or faster or more efficiently? Or what are there any strategies with respect to that you guys implement?
There's wells. These are fairly shallow wells, 2,900 feet. Just because of this part of Texas where the oil field is, it's you can find oil without having to go 5,000 or 7,000 feet. And so part of it is using the geology to see what if we went another 50 feet deeper, another 100 feet deeper, right? So basically using that to determine where are there other pockets in this well of oil that we could then drill down further would be one of the areas. And then there's other techniques. These are basically vertical wells, and we haven't gone into a lot of the horizontal fracking, which is another way to extract more oil out. And so for these wells, we're basically doing the more conservative vertical drilling. And then if anything, we would drill a little bit deeper. And then there's a depletion percentage each year that you count on. So you're taking oil out, so you're depleting the reserves. And so the depletion percentage has been less than we underwrote, than we forecasted. And so, that's good news for the investors, we still are continuing to find, more oil in there, even though we keep pumping, quite a bit out.
Okay. And just kind of going back to also one of the other things that you had mentioned, and really I'm just curious. I love having people on that talk about this stuff because it is just it's interesting. But you mentioned that maybe there was a stipulation. I don't know if it was with the prior leaseholders that you purchased from, but that once if you can get them producing above, or maybe if oil goes above a certain dollar amount, it was, I think you used the 90 something a barrel.
Yeah.
Then you have the ability to actually drill more wells. Is that correct?
Right.
Okay.
Yeah. So we have the rights to drill 12 more wells as part of the 52 producing wells. There's another 12 sites that are in the oil field that have never been drilled. So that's more of the wildcatting. And then that's where you do the exploratory wells. And it can cost, like $500K to drill a new well. And so yeah, that's what we have the rights to do. And if the price per barrel of oil are 90 or higher, then we start generating that excess capital that still can pay all the preferred returns to the limited partners. And so that's the piece that we'll see, during this lifespan, if that happens. It did hit over 90. Like it was probably August, September last year, but then it went down to the 70s, and now it's been hovering around 80. So it's very possible, with the geopolitical stuff going on, that it could hit 90 and higher. But we're not necessarily counting on that for the base business case. Then the other thing that people look for on oil and gas deals when limited partners are analyzing, do I invest? What's the break even? So the break even on this is 38 a barrel. So if the price per barrel of West Texas crude ever goes below $38, then we're not in the money anymore. And the likelihood of that happening is not high, but it's possible. People want to know, just like if you invest in natural gas, at one point it was like $9 per cubic feet. Now it's like, $1.70. You want to know for the operator, hey, what's your break even on pulling out natural gas? Because some operators, their break even was like $4, and that's just not economical. So they just cap it. They just leave it in the ground. For oil, if some operators say, hey, our break even is 75, then if it stays below 75 for a period of time, they might cap the well and save it for later.
And what dictates that break-even point? Is it just how efficient the operator is, or is it based on the price of, like, say, that was a pretty big drop from, I think you used the example of $9, and then it went down all the way to $1.75 being the break-even for natural gas.
Yeah. That happened recently. Yeah.
And that's just based on the fluctuation of the natural gas prices, or that's has something to do with the operator's efficiency with it?
Yeah. I mean, so the market price is the market price. The cost for the break even is the operator. So for us, we in this particular syndication knew how to negotiate the leases. So a lot of it is the existing leases with that equipment, and then the operations. So the people that are leading this for us, the lead general partners, are the oil field experts. They used to run these wells, and so they know what the cost should be, and they know how to keep the costs in line. They know all of the vendors that provide, all the fluids and everything to keep the pumps running. And so they're able to keep the costs down to where it can be $38 a barrel.
That's great. Okay. Very interesting stuff.
Yeah.
And then as far as the new oil wells or pumps that you have the ability or the right to be able to do, you mentioned around 500,000. Is there a option or an ability to be able to syndicate the wells themselves and say, hey, we need some investor money for this, and this is what we're expecting they'll produce, and kind of go at it that way?
Yeah, there's an option to do that. The first plan was to take and give the first rights to all existing limited partners in the deal. And then if we need to raise more capital, then we've got the right to go outside and raise more capital if we wanted to go and do some of the wildcatting on those unproven wells. So that would be the plan if we needed to raise more capital.
Okay. That's very interesting. Well, maybe if we could talk a little bit about kind of your journey with, financial freedom and, some stuff associated with that would be important for the audience to know. Just obviously there's just a ton of things. I mean, just with your own experience on these various, whether it be multifamily, oil wells, land development, and just there's been a ton of things in the ATMs as well. There's so many avenues out there to be able to build wealth and really find that financial freedom.
Right, exactly. And like I said, I did a lot of education early on to get kind of a baseline of, hey, how could we reduce our taxes? So, tax-free wealth by Tom Wheelwright and things like that. And reading a lot of the Rich Dad and cash flow quadrants and all those kinds of things. So I got a baseline of, well, I want to move from being a W-2 employee in let's say a large company. I want to move to the investor. I want to move from 40% taxes to zero. Like, how do I do that? I don't want to be the self-employed. I don't necessarily want to be a business owner of 500 employees. I want to be the investor that pays, like zero in taxes. And so that was, part of my, kind of aha moment. And then over the years, we paid extra for tax planning and strategy advice. We went to a company called Provision and we paid for that to kind of get this master plan of how should we do asset protection? How should we set up a trust and the different LLCs, like the Texas Series LLCs? So we got sophisticated. We hired people that were more knowledgeable. We joined, these masterminds to accelerate our knowledge because we didn't know a lot about these different asset classes as we got into them. And then just the whole thought about moving away from Wall Street to Main Street, moving away from someone else managing your money and all the back end fees and all that stuff that we have a hard time getting a great return on, to moving to physical assets, right, that you can actually manage and control. And it's a smaller, like I didn't know, 9 years ago we could invest in syndications. I didn't know what that was. And so, just learning along the way and surrounding yourself with people that are further along than you are at that stage, and that have been through those cycles, that have been through those asset classes, that can help coach, mentor you. I think that's, kind of, what we learned. And then we took some risks, obviously. We took some money out of Wall Street and we put it in these Main Street assets and diversified it around to different asset classes and all. But there's risks, with anything involved, but we're trying to take educated, calculated risks. And so it's been a journey to where, my wife and I have been able to leave our W-2 jobs a few years ago. So I mentioned, short-term rentals. So my wife focused on that. So she left her law firm, her paralegal position in Austin a few years ago to focus on our short-term rental business, full time. She qualified as a real estate professional, which this could be going into the weeds, but it's a CPA, type designation from the IRS. So she did that. And so then we were able to offset, with passive losses, my W-2 income at the time working for Microsoft. So, we just learned a lot of those things from people smarter than us and, paying for some professional help to accelerate, our journey. Otherwise, we would have been working until 65, et cetera. And then the other personal thing on my side is my dad passed away of a heart attack when he was 55. And so when I turned 50 is when I said, wait a minute, like I want to try and accelerate my early retirement from the W-2 and working for a company, and let's focus on our own businesses. Let's start this. And so I had some, kind of personal reasons. And, my grandfather, my dad's dad on his side died when he was 51. So we just have this kind of history. So you want to like live your life to the fullest. And so we wanted to be able to reach that, financial freedom and to go travel. So now we travel in our Airstream and, we travel to Mexico and Europe and all that kind of stuff. So it just provides us, what we need with a lot less stress.
Yeah, that's great. Well, congratulations on making that journey, and it is pretty neat. Yeah, you mentioned masterminds. Any particular ones that you're a fan of, that or maybe ones that for certain stages of your life you were good with?
We joined this big dog group. They have chapters in San Antonio, Austin, Houston, Dallas. And that was a good way to start, right? So, I think for, real estate, single family, if you want to learn the fix and flip, you want to learn the wholesaling business, you want to learn some of that. We've also joined a group called Odyssey. They do short-term rentals, And so there's a podcast out there, Sean Moore of Odyssey. So, we've done that. We've joined these various apartment syndications and had, help along the way. I'm also in, Kyle Wilson's mastermind, which is where I got introduced to the ATM stuff through Dave Zook. So Dave has been around the ATM space for a very long time, along with lots of other asset classes. And so I met Dave, through Kyle Wilson's mastermind. So, so those are a few.
Yeah, for sure. Okay, cool. Well, it's always good to hear. They definitely are helpful, and it is something that people should take a look at.
Exactly. Yeah.
And then I guess why don't we go to maybe where people can find out more about you, Jeff, and if they want to hear about maybe some of the investments that you have coming up.
Sure. So, LinkedIn, Jeff McKee, I have like 12,000 first connections, so I should be pretty easy to find. And then my website is McKee Capital Group, so MCKEE Capital Group.com. So, and then on there's a tab called Open Offering. So for accredited investors, there's a lot of detail about the ATM offering. So it's got the overview, it's got a pitch deck, it's got a recorded webinar. So it's got all that information. So people want to look at some of that level of detail. And then honestly, other than the ATM, we don't have a robust pipeline of when is our next, multifamily offering? When is the next land syndication? When is the next oil syndication? So it's just in limbo. But people can get a hold of me, like Jeff at McKeeCapitalGroup.com. And then we can have a conversation. Then I can add you to my investor database for future offerings. And that way people will be in the know. Some of them will be, non-advertised, allowing non-accredited investors. So the 506B, probably it'll be an apartment deal that we'll do next. Our last apartment deal we closed just over a year ago in Scottsdale, Arizona. And so we may be doing another one in the Phoenix area with the same group of people. So we'll see if that's the next one that's up. But we have assets, from Arizona to Florida, typically the Sun Belt, landlord friendly, tenant friendly. Landlord friendly, business friendly, a lot of net in-migration states. So that's where we focus the multifamily. And then these other asset classes, the ATM one is one that we'll have the next offering here in another month or two, because we just filled up the last fund. So we'll be coming out with the next fund. The return should still be the same at the 24.9% cash on cash return annually, paid monthly.
How about as far as the market, looking out at the market, just always like to get a poll from everybody, kind of what do you see in the, whether it be with the interest rates, whether it be with just the multifamily market itself?
Yeah, I think it's definitely taken longer than people had anticipated to actually start, ticking down on the rates. So I guess we're looking at June of 24 for the first reduction. And then, like people were saying, it was an elevator on the way up, and it's going to be an escalator on the way down. So some of those rate hikes were 0.75, and then on the side coming down, it's going to be 0.25.
Yeah.
And so it's going to take a long time to get back down. And so I know on the residential side, they always look for less than a 6% mortgage. And today, I think mortgage rates are right at 7%. And so that 6% is going to take at least a year from now, probably. And then that also has an impact on multifamily. Like, hey, if it's expensive to do a single family home, I'm going to stay in my multifamily longer. So for multifamily, it can be a good thing. But then on the opposite side, you've got the debt on multifamily, especially the bridge debt that's coming due. And if your property isn't stabilized above 90% occupancy for 90 days, you can't roll into agency fixed rate debt like Fannie Mae, Freddie Mac. And so then that's a challenge on some of the multifamily. The deals that I've been seeing lately on multifamily have been more assumptions. Someone, is assuming a Freddie Mac loan or Fannie Mae loan, and it was an assumable loan, and it's got, a prepayment penalty for another couple of years. And so the new owners can take over that loan at 2.5%, 3.5%. And the current owners get paid a premium per door. And then the new owners get a good debt that's fixed rate. So those are probably at least half of the deals that I'm seeing. I think the capitalization rates, are still struggling. I mean, I think they're still fairly high. So when you look at the net operating income divided by the cap rate, the value of a lot of the multifamily deals aren't what they used to be. And so that, I think that capitalization rates will also take some time to start compressing and coming back down. And then we've also, started looking at some of the newer assets, more of the class B, like 1990s, 1995, 2000 type assets. Because we had done some deep value add class C. It's just tough sometimes for property management to be able to raise rents on some of those class C properties. And then the deferred maintenance, some of them built in the late 60s or 70s. There's more deferred maintenance than we had underwritten in our expenses for the maintenance part. And so some of those were, at least going forward, when we look at a buy box of multifamily, it's typically going to be a class B or newer, 1990s or newer. And typically we've seen better performance in large MSAs, let's say DFW, San Antonio, Austin, Phoenix, et cetera, versus tertiary cities, the small cities. So we're starting, to focus more on the larger cities. And then, the sweet spot, we believe, is about 100 units to 250 units for multifamily for us, for our buying group. We tried doing some 500, some 800 unit. Those are just really large to manage. And then when you get below 100, maybe 80 is fine. When you start getting into 40 and 50, it's hard to find a property management firm that will manage that for you. And we don't have our own, first party property management. We do all third party. So that's where we're looking at 100 to 250 units, class B, in a large MSA built 1990s or newer. And probably more than 80% occupancy, so that if it doesn't already have fixed rate, if it's not an assumable deal, that we can put agency debt on it within 12 months. So those are just some of the things on the multifamily side. But it's going to take longer than I think what we had hoped for. Maybe we didn't expect it, but maybe it's going to be a longer road to recovery on some of that. But there still will be deals coming to market, distressed assets that could come at a good price per door, that some investors may find some very good opportunities out there to invest in.
Yeah, great. Okay. Well, appreciate that, Jeff. And this has been really good. I know we kind of bounced all over the map here as far as different asset classes, but it was you were very knowledgeable, it seems, on most all of them. So really appreciate that. I've got two other questions for you that I ask every guest, and one of them is just what advice you would give somebody who's maybe just starting out in their investment journey.
Yeah, we talked about it. I think it's the mentors and masterminds. That to me has probably been the biggest single piece. Obviously, I read a lot of books, I listened to a ton of podcasts, but when you get around people that are much further along, let's say in that asset class than you are, you can accelerate your knowledge and maybe gain some experience to get up to speed faster. And that's what I was looking for, was how could we ramp up our education knowledge and start investing wisely in these different asset classes sooner? And some cases you've got to pay for that. And so I wouldn't necessarily call it a pay to play, but you do get to rub shoulders with people that are much further along. And whether that's, coaching, mentoring, and getting alongside people that are going to become your peers, and they can help accelerate your knowledge and bring you into a team on a deal. And then you start getting experience instead of just reading about it, and always, analyzing and postponing, taking action. I was a firm believer in taking calculated risks and action and not just over analyzing too much. So that was where I erred on the side of taking action and putting some money out there to join these masterminds or pay for advanced tax planning and strategy help to try to get a good baseline, so we were going down the right path, and then we could just execute on that plan instead of having to somehow create it on our own.
Yeah, that's great advice. How about one more question for you? Just any book advice or book recommendations? Doesn't have to be real estate related, but it certainly can be. Just something that's been impactful to you.
Yeah. Two. One that I mentioned was Cash Flow Quadrant, Robert Kiyosaki. Again, it's the whole mindset of moving, at least from my perspective, from a W-2 employee to, basically an investor. How do I make that transition over time? So that to me was an awesome book. And then Who Not How by Dan Sullivan and Dr. Benjamin Hardy. So who, not how, just, you don't have to do everything. You don't have to know everything. You need to be able to hire the right people. Like I have a virtual assistant, in the Philippines that helps me out, right? And then I've hired a contract writer to help me out before with some blogs. I've hired a web designer to help me with my McKee Capital Group website and some of the back end things, because I don't know WordPress. I don't know a lot of those things. And so I hire things out. And so, the who, not how is you don't have to do it all yourself. And obviously, like the CPA, we hire that out. We hire lawyers out. And so, so those kinds of things, to not be afraid to accelerate by using, other resources, and that you don't have to be an expert at all these things.
Yeah, that two great book recommendations as well. So, all right. Well, thank you so much, Jeff. This has really been good. I appreciate you being on the Wealth Flow, and I think we'll call it a show.
All right. Thank you, Keith. Appreciate it.
Yeah.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.